Hey there, Dave Keller here with Market Misbehavior. Today we're going to talk about a technique that I use often when I'm thinking about particular price levels and kind of setting a game plan or a structure with how to approach a particular chart, called the traffic light approach. What we do basically is identify a couple key levels to focus on and then go green light, yellow light, red light as a way of laying out a potential future path and giving us a sense of risk versus reward. We're going to look at the S&P 500, also picked another stock or two to sort of dig into and show how we can sort of approach the market using the sort of traffic light approach, and just some of the ways we can do it on a platform like stock charts. Whatever platform you're using, you can probably find some similar ways to lay out that structure on a chart of interest. Before we get to the traffic light approach and its implications, just want to let you guys know I'm doing a webcast on Wednesday, December 17th, 2025, called Winners, Losers, and Lessons, your year-end investment review. At the end of every year in December, I always do what I call the 10 questions. It's a group of questions focusing on three major topics. Number one, our wins and losses. What did we do well? What did we do poorly? What can we learn from our best trades? What can we learn from our difficult trades? Number two, we talk about market conditions, right? What opportunities did we identify? What opportunities did we miss? Where are some blind spots in our process that came out of the year? And then finally, all about process and routines. What are we doing every day, every week, every month? And what are some of the improvements we can make to those processes in the new year? The last question is all about mindset, and I hope you find this free webcast, spending some time together, gives you an opportunity to reflect on how you evolved as an investor in 2025, and hopefully set yourself up for some great improvement to those processes and returns in 2026. You can sign up for that free event coming up next week on Wednesday, December 17th at marketmisbehavior.com/lessons. All right, so here is a chart of the S&P 500 using the stoplight approach. So this is a chart I featured a number of times on my market recap show. That's called Chart This with Dave Keller. It's on this YouTube channel every weekday after the close. And what we've been talking about here in recent weeks is applying this kind of traffic light approach to the S&P 500. Now, why did we apply this traffic light approach? And then I'll show you how we actually put it together. So it comes from when a market has a change, right? So if you look at the market back here in like July, August, September into October, we're in a nice low volatility uptrend, higher highs and higher lows. This is the S&P 500 we're looking at. You can see this pretty consistent uptrend channel where we have trend lines that connect the highs and the lows. Looks like a pretty consistent uptrend phase. But then after this peak just before Halloween, here in the U.S., we have sort of a sideways pattern, right? That peak just above 6,900 was the all-time high, and from there we pulled back. Now, while we didn't make a lower low, we basically retested this low from early October, but now all of a sudden we have sort of this framework, right? We have an all-time high at 6,900. We now have a swing low around 6,550. That was the swing low from earlier in October. It also lines up with swing lows in late September. And now, of course, it's further validated by that test of the lows third week in November. So as we sort of remain in this range, I immediately think of this chart like a traffic light. All right, now we have sort of defined this sideways or consolidation phase, right? And I think of a market as in one of three phases. An accumulation phase is a trend of higher highs and higher lows. A distribution phase would be lower lows and lower highs. A consolidation phase is a sideways trend of equal highs and equal lows, sort of like a rectangle. It's kind of what this market has been doing, right, over the last 10 weeks or so. So if we think of the 6,900 level, that's been our ceiling in the market. So I would say if and when the S&P can power above that 6,900 level, if it can demonstrate that we're in a new accumulation phase, we're back to making higher highs again, which we haven't made since the end of October, then I would say the market's back in an accumulation phase. That's a bullish breakout. So anything above 6,900 I would see as fairly bullish. Anything below 6,550, well, that would mean we're actually clearing the low at 6,550. That's the low from November, from October, from September. Well, we've had 4 or 5 different tests of that same price point. So as long as that keeps holding, things are okay. But if and when we would break below 65.50, I would say that's a pretty negative breakdown. And so for me, anything below 65.50, it's kind of a red light. That's a new distribution phase. I'd probably want to be pretty defensive there. And then anything between 65.50 and 6,900, there's could be plenty of tradable movements within that range, but as long as we remain within that range, I would say the market is neutral, right? Highs and lows are fairly stable. We remain within this price range. What we've basically done is talk through this traffic light approach. All the traffic light does is sort of illustrate those, those levels and their meaning visually. I'm a big fan of using charts to visually represent a game plan, to give us more structure in terms of how we think about a chart, as opposed to just looking at the price bars and kind of making it up, right? Giving a little more structure helps us think about what might happen next and recognize that anything sort of in this range, right, between now and year end and even into early January, is more noise than signal. I think the real signal would be a break above 6,900, pretty bullish new accumulation, break below 65.50, pretty bearish period of distribution. So how do we set up this kind of chart? How do we kind of review it? Well, before we get there, I just want to point out the S&P 500 in the last couple weeks has really respected this traffic light approach. And so when we set this up, we were looking at the S&P 500. I didn't know it was going to sit up against the upper boundary of this kind of traffic light pattern for so long, but that's exactly what it's done. Even Friday, December 12th, which is when we're recording this video, this is when Broadcom came out before the open, disappointing earnings, and so today was a pretty big distribution day with Broadcom down over 10%. A lot of the other semiconductors, a lot of other technology names, kind of that whole AI trade sold off, and the technology sector was the worst performer in the S&P 500. And so it, while Wednesday and Thursday traded right up to the green light section, it seemed almost like a foregone conclusion that we were going to power above 6,900 imminently. It didn't happen, and Friday ended up just sort of reinforcing yet again the importance of this level of resistance and the fact that it had not yet broken. So times like these, I'm reminded as to why this kind of approach is helpful, because it's very easy to hear a narrative or see what someone posts on social media and think, all right, I should get long, because it's the FOMO that's motivating that. It's the fear of missing out becomes a great motivator for bad buy decisions sometimes. So this was a great sort of, let's tap the brakes on the optimism and wait for the chart to actually deserve that optimism. So how do we set that up? Well, obviously every charting platform is a little different. Stock charts is one of the primary charting tools that I use kind of day in, day out. So I'm going to use that as our example chart here. But just remember that whatever charting platform you use, chances are you can probably do this sort of stoplight technique. So I'm going to zoom in a little bit, just like the last 6 months, just kind of give us a little better structure here. So we're looking at the last 6 months. I have price with moving averages, and then I have the RSI at the bottom, and you can see the moving averages that I'm using here. If you want to recreate this kind of chart, I'm using a simple 14-day RSI as a way to validate what we're seeing with the price. So what I like to do is different ways you can do this, and some charting platforms have like probably a traffic light, more sophisticated shading tool. I know on Stock Charts ACP, the advanced charting platform, is actually a traffic light tool that allows you to create this visualization very, very easily. But what it's essentially doing is recreating what I'm about to show you. So what I do is, first off, identify the level. So what I actually often do is take some big horizontal lines, and I'll do like a big, thick, like blue kind of neutral color line, and just kind of identify it. So 6,900 for me kind of stands out, because that's the high in October. We can see that lines up really well with the highs we've experienced over the last week and week and a half, right? So 6,900, big round number, that's kind of the level. That's where we stalled out here. That's where we're stalling out again. Every time we test that level, I would say it further validates that this is the upper end of the base, but it also means a break above would be pretty bullish. On the downside, again, just visually, if you take a step back from your monitor, pretty clear that 65.50 is a pretty clear level. Now, you can, kind of nickel and dime this and really try to identify a precise level. One thing I have learned in the age of decimalization and the age of, sub-penny spreads between on different charts, I don't think precise levels on something like the S&P has a lot of meaning. I don't think if the S&P hits 65.51 versus 65.49, that's a dramatically different message. I would just, and so that's why I give a lot of wiggle room. I think of them more as general levels and not as precise levels. Back in the day when something like IBM traded on 1/8 of a dollar as its smaller increment, I bet you could have a better expectation about a precise level being hit. But nowadays, I think that's expecting a level of precision that is not there anymore. So I kind of just pick big round numbers that represent the general area where I think we've changed from neutral to bearish. And as we mentioned before, a break below 65.50 I think would be meaningful because we've found support there a number of times. Buyers have been coming in all through September and October and November around that point. So reasonable to expect that if we would retrace back down there, I wouldn't be surprised if buyers came in again and further validated that level. If we didn't find support there, if the S&P did not find support there, that tells me something's different because support is no longer holding, which means buyers are no longer willing to come in and buy on the weakness again. And it also means that we are making a lower low, which is Charles Dow's kind of basic way of defining a downtrend. So just using some big, thick trend lines for me kind of gives a good starting point and gives us a sense of how to set it up. Then what I do in stock charts is I actually use the rectangle tool. And I go up here, and on stock charts, you can actually make the colors a little more transparent so you can see through them a little bit. I kind of go with that vibe, and then I just kind of draw some rectangles. So here, we're saying anything above 6,900, there's a green light, and then we draw one that's kind of this kind of neutral. I usually do orange because yellow is kind of hard to see, but you could use yellow if you want. It's up to you. And then this is kind of like a neutral, beigeish, yellowish color. Neutral, and then we do one more, and I mean anything below this is probably pretty bad, but we don't have to make a whole thing of it. Let's just put it down to there, and let's make that kind of a bearish red color, right? So now we've clearly defined this framework, right? And all I've done is basically take the phase approach we talked about, an accumulation phase, a distribution phase, or a consolidation phase, and what I'm doing, what I'm expressing on this chart is saying, look, the chart of the S&P is now sideways. It's in a consolidation phase. So the way to determine where to put these levels, answer the question. Number one, what would you need to see on this chart to tell you you've gone from a consolidation phase to a new bullish phase? For me, that's a break above 6,900. What would it take to go from a consolidation phase to a new distribution phase or a bearish phase? That's a break below 65.50. And that's how we can define those levels and sort of set this up. Now, it's worth noting, right? Do we use this in a vacuum? We do not, right? So moving averages still matter, right? If moving averages line up with some of these levels, that might further validate or, invalidate some of these things that we've talked about. Looking at momentum, right? When the price, if and when the price would break above 6,900, is there stronger momentum that would imply accumulation? Is the volume better, which would sort of further validate, yeah, this is real accumulation and real potential for further upside? I'm not a fan of just kind of using this on its own. I think validating, confirming it, or recognizing that other indicators can help us make a more informed assessment as to whether a breakout is a good breakout that's likely to continue or a potentially failed breakout on weaker momentum and weaker volume. Those kind of confirmational tools can matter a great deal. But let's start out with the basic premise of getting out of this range is what we're actively looking for. The final point is it's worth noting that this traffic light approach is not relevant all the time, right? Sometimes when we're in a consistent uptrend, it just doesn't make sense, right? Because I don't think there's a clear support and resistance range to work with. Any time that I find when I'm looking at the chart, I can draw a rectangle around the recent price action, and it kind of describes that region of price action pretty well, then I know I need to sort of go to this traffic light approach and start putting some assumptions on there. So that's the chart of the S&P with that kind of traffic light scenario. This is not just about the S&P. This is not just about a particular chart. You can use this all the time. So here's Lululemon, which is just today gapped higher, right? Pushing a little bit higher. So this is one where I would think a similar sort of traffic light approach might make a ton of sense. We'll zoom in a little bit just the last 9 months so we can look at this section here, right? So here we have a clear distribution phase, lower highs and lower lows. Now we're in kind of this sideways rectangular shape. So let's do the same thing we did on the chart of the S&P. First, we'll draw some big meaty trend lines. And again, you don't have to do this, but for me, as I'm kind of just getting started, pretty helpful. Now, pretty obvious, like 160, like that's the level, right? That's where we hit support in September. We then got almost exactly to that in mid-October. We got almost precisely to that in early November, a little bit above there. Third week in November, we bounced off. So 160 or roundabouts there are certainly where it appears that buyers are ready to come in and buy some more Lululemon, right? That's where value investors have felt this is a pretty good place to get in. The upper end, a little questionable, right? I could see you arguably putting it like here. I could see maybe putting it a little bit higher. Maybe we'll start here because it lines up with this swing low back here in early August. Seems to me about like 185 or so. We'll put it like around 185. That seems to be a pretty good level, right? That's where we bounced off of support in August. The gap lower got through there, and then we've had a couple times where we've failed to get above there. Now, obviously, we've gapped higher in a pretty big way. So again, we apply our same kind of methodology here. First, we do the bullish green one. So I would say kind of anything above here is probably pretty bullish because we've now broken above our level of resistance. I would say anything in the middle, probably neutral because we remain within this range. And obviously I'm showing this after the stock has already broken out, right? So clearly this chart for now has resolved this traffic light approach to the upside. Now we're at the bottom of the page. So I've added like a little free space here just to show you, but on some charting platforms, you can probably just automate and have like a nice downward space. So then here I'm showing anything below 160 would be bearish. So similar to what we talked about the S&P, different trend going into the sideways pattern, right? Well, on the S&P, we're in an uptrend, and then we went into a consolidation. Here, we're in a downtrend, and then again, went into a consolidation, but I think the framework still resonates. And back here, when we're kind of middle of the road and the moving averages are flat, that's when we want to implement this traffic light approach, right? And then it clearly tells us anything above 185, that's where I may want to start to get interested. Setting an alert around 185 is a really good thing to do at that point because then you don't have to look at this chart every day. You just wait for the trigger to pop up. Anything below 160 would make a new low and would suggest that we're resuming a distribution phase that we saw back there in the summer. So anything below 160, I'd probably set a price alert for Lulu below 160 as a breakdown, and then anything between 160 and 185, that's neutral. So this traffic light approach, again, is more of a visual technique than anything. But since I've applied it recently on the chart of the S&P 500, I thought it would be important to share with you sort of why it is that I go into that. And again, anytime I find myself describing a chart as in a sideways kind of rectangular pattern, what I call a consolidation phase, that's when a traffic light approach can be very helpful. I don't think this substitutes or takes away from other kind of traditional technical approaches. For me, it's just a visual representation of the current state of the trend, the sideways nature to the chart, and just acknowledging and putting some thought into what levels would be a bullish breakout, what level would constitute a bearish breakdown. And then just the things in the middle, that's when you sit on your hands and wait for the market to tell you whether this chart is going to resolve to the upside or the downside. What do you think of this stoplight approach? Are there other charts that you see right now where you think it could be helpful? Have you given it a shot? Put a comment below and let me know. I'd love to see what charts you are looking at and struggling with these days. That'll do it for today. I'm Dave Keller with Market Misbehavior. Don't forget about my daily market recap show called Chart This with Dave Keller. Also, the Market Misbehavior podcast. A lot of great conversations here on the YouTube channel and all your favorite podcasting platforms. But for now, we'll say have a great night. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts.